Hi everyone, Michael Ma here with Emeritus Wealth Management. Today I want to talk about something that most people don't like to think about, but that your family will absolutely need to understand. What actually happens to your TIAA accounts when you pass away? This is one of those topics where a little planning up front can make an enormous difference for the people you leave behind. So let's walk through it. The first thing to understand is this. What happens to your TIAA money at death depends largely on two things: what type of account you have and what elections you've already made. Let's start with the accumulation phase, meaning you're still working and haven't yet begun taking income from your accounts. If you pass away during the accumulation phase, your named beneficiaries receive your account balance. For your variable annuity accounts and mutual fund holdings within TIAA, this works similar to any other retirement account. Your beneficiary contacts TIAA, files a claim, and receives the assets. If your beneficiary is your spouse, they generally have the option to roll the assets into their own IRA, which can provide significant tax planning flexibility. If your beneficiary is a non-spouse, a child, a sibling, another family member, they would typically receive the assets as an inherited IRA. Under current IRS rules, most non-spouse beneficiaries must fully distribute an inherited retirement account within 10 years. That can create a meaningful tax event, especially if the account is large, because those distributions are taxed as ordinary income. So naming the right beneficiary and thinking about the tax impact on that person is an important part of the planning. Now, let's talk about TIAA Traditional during the accumulation phase. If you haven't annuitized, meaning you haven't converted TIAA Traditional to a lifetime income stream, your beneficiary generally has two options when they inherit. And this decision is important because once they make it, they cannot change it. The first option is to retain the TIAA Traditional account. The beneficiary keeps the money inside TIAA Traditional, continuing to earn the crediting rate, but they inherit the same liquidity restrictions that apply to the original contract. Depending on the contract type, that may mean limited ability to move or access the funds freely. The second option is to take a lump sum distribution, moving the money out of TIAA Traditional entirely at once. This gives them immediate access and full flexibility, but they give up the guaranteed crediting rate going forward. Now, here's what makes this especially consequential. Whether your beneficiary is a spouse, a child, or any other family member, this election works the same way. Once they choose, retain the TIA Traditional within its liquidity restrictions, or take the lump sum and move on, the decision is final and it cannot be reversed. So it's worth making sure your beneficiaries understand this choice exists and what the trade-offs are before they're sitting across from TIA in an emotionally difficult moment trying to make a permanent financial decision. Now let's talk about what happens if you already annuitize, meaning you've elected lifetime income from your TIAA. This is where things get significantly more nuanced. What your beneficiary receives depends entirely on the payout option you elected at the time you annuitize. If you chose a single life annuity, income was calculated to last for your lifetime only. When you pass away, the income can potentially stop. There's nothing left for your beneficiaries from that annuity. If you choose a joint and survivor annuity, your surviving spouse continues to receive income after you're gone. The amount depends on the option, typically 50%, two-thirds, or 100% of the original payment. This continues for the rest of your spouse's life. If you chose a period certain option, payments are guaranteed for a minimum period, commonly 10, 15 to 20 years. If you pass away before that period ends, your beneficiary receives the remaining payments for the rest of that guarantee period. Here's why this matters so much. Once you annuitize your TIAA Traditional, that election is permanent. You cannot go back and change your payout option after the fact. So the decision you make about which annuity option to choose directly determines what your spouse or family will receive if you die first. This is not a form to rush through. It deserves careful thought, ideally in consultation with a financial advisor who understands the implications of each option. Now, a few practical points for your beneficiaries to know. When you pass away, your beneficiary will need to contact TIAA directly to initiate the claims process. They'll typically need a certified copy of your death certificate, and depending on the situation, additional documentation related to the plan or contract. TIAA does have a dedicated team that handles beneficiary claims, and in most cases, the process is manageable if the beneficiary designations are up to date and clear. The problem arises when beneficiary designations are outdated, multiple contracts have conflicting information, or no beneficiary was named at all, in which case the assets may need to go through probate, which can be slow, costly, and public. At the end of the day, your TIAA account represents years of hard work and careful savings. Making sure those assets reach the right people in the right way when you're gone is one of the most important acts of your financial planning you can do for your family. That means reviewing your beneficiary designation on every contract regularly, understanding what your annuity elections mean for your survivors, making sure your beneficiaries know about the TIAA traditional election, and that once they make it, it cannot be undone, and making sure your family knows where your accounts are and how to access them. Thanks again for your time. Emeritus Wealth Management is not affiliated with TIAA. This content is for informational purposes only and should not be considered individualized financial advice. Please consult with your advisor before making any financial decisions. Investment advice offered through Stratus Wealth Advisors LLC, a registered investment advisor. Stratus Wealth Advisor LLC and Emeritus Wealth Partners are separate entities.